Ajay Bodke also joining us this morning. Ajay, how are the markets looking to you? Are you also expecting us to see further weakness on the back of what we're seeing globally? Yesterday we managed to hold out, but what's in store now?
Good morning. I think if the global markets continue to display weakness, at some point in time, I think we'll also have to mirror and reflect that weakness. However, I believe that India will be far better off as compared to many other competing destinations for foreign flows. Essentially because we are a domestic focused and domestic demand driven economy with around 60 to 70% of our GDP constituting domestic consumption and net exports forming hardly 15% of the total GDP. Unlike the Far Eastern economies where we have seen massive plunge in, say, for instance, in Japan or in other Far Eastern economies, because net exports form the bulwark of the total GDP out there. Also, we'll be better off as compared to many other commodity exporting economies. You take from the Western Hemisphere economies like Brazil, Argentina, South Africa, Russia, even some of the developed economies like Australia and Canada, which depend mainly on export of industrial commodities. And that's where with crude plunging and industrial metal prices plunging as a result of uncertainty in the global economic outlook, I think as a large importing economy, India stands to benefit because the macroeconomic fundamentals based on current account and trade deficit will see sharp improvement. Every dollar fall in crude leads to $1 billion of savings in import bill, and the government subsidy bill also comes down because of savings on LPG and kerosene subsidies. Also, the fears of imported inflation get dampened as crude prices come off. That will aid RBI in its pursuit of accommodative monetary stance. And lastly, I think our forex reserves are at the highest levels. The government is fiscally prudent, committed to medium-term fiscal consolidation plan, and the government has moved very quickly after RBI governor's exit to ensure that the Monetary Policy Committee is put in place as soon as possible. And as long as the government nominates someone who is seen to be internationally credible to conduct an independent monetary policy, I think we are in a good territory with a medium-term perspective. And the government's emphasis on increasing investment caps for various sectors has led to India emerging as the largest destination for FDI inflows, which are far more durable in nature. So I think overall, we would be able to ride out this storm, in my opinion, quite comfortably. However, I think if there is a very sharp plunge, then as I said, we will also be part of it. But whenever semblance of sanity returns, we will bounce back and bounce back very strongly because the corporate earnings are on the mend. With the exception of public sector banks and corporate focused private banks, the fourth quarter numbers were very far better as compared to third quarter numbers. And there are 3 or 4 drivers for domestic demand coming up in next 3 to 4 months. We have today seen in papers that the 7th pay commission checks will start flowing into the pockets of central government employees in August or September. That's a large bump up for consumption demand. Monsoons have, after a delay for the first 15 days, picked up pace, and one is expecting near normal monsoons, which will aid rural demand, which has been compressed for last 2 years. And rural folks constitute 60% of our total. They're still dependent on agricultural and allied activities. And lastly, with the expectation of passage of GST, yesterday's interview, the Prime Minister has very clearly indicated that with the exception of one particular party, I think there is a broad consensus among all the political parties from the East and South regional parties to help the government in passage of GST. And that again will send a signal to the markets that the government is committed to pushing through reforms, especially after an extraordinarily productive budget session where Aadhaar, bankruptcy bill, mines and minerals amendment bill and real estate regulation bill were cleared. So I think all in all, we should be able to weather this storm comfortably, in my opinion.
Okay. Ajay, a lot of these, pharma names that were in focus yesterday as well. Within the pack, are there any selective names that you're looking at? Given all the news, Brexit, but we're also tracking the stay on the NPPA order on pricing as well. What's catching your eye from the pharma pack?
There are 3 bottom-up ideas that I am extremely bullish in pharma with a medium-term perspective. I think the first is Aurobindo Pharma. There we are expecting a very strong revenue growth of around 17% in the current financial year. and an earnings growth of 35% in FY17, followed by around 23% in FY18. And the stock is showing positive trends in ROE. From 16% ROE in the current year, we are expecting it to trend up to around 18%. And we feel that for the medium-term perspective, there is still a 35 to 40% upside if you take a 12 to 15-month perspective. So 943 is the target we are looking at in case of Aurobindo Pharma. A lot of ANDA approvals the company is expecting over the next 12 to 15 months. The other stock in the pharma space we like is Jubilant Life Sciences. Now the stock, 50% of the business comes from life science chemicals, 50% comes from pharmaceuticals. And the pharmaceuticals business, there is one particular niche that the company has, radiopharmaceuticals, which is a unique niche, and no other company in the Indian pharma space is present in that. So whenever you go for various types of scans, for instance, I think these are the pharmaceuticals that one uses. The company has a strong presence in American markets and European markets and Canadian markets. And they are expecting a launch of a key product called RubyFill, either in third or fourth quarter of the current financial year, which will provide a good boost to the earnings for the company. And the pharma business has been separated into a fully owned subsidiary of the listed company. And at some point in time, we believe that monetization will happen in the pharma business. And that's when sort of the markets will realize the value of that great franchise that they have in terms of radiopharmaceuticals. So there, I think, we are expecting again pretty strong growth sort of over the medium term. The third franchise we like in pharma is Glenmark Pharma. The company had disappointed in last 1 year because of the sharp plunge in currencies, especially in the Latin American countries. And however, I think the company's main business in terms of the American franchise holds pretty strong. The company is getting a lot of approvals from the US FDA, and Zetia, which is a key product for them, also we are expecting an approval sometime soon. So in case of Glenmark, in fact, we are penciling in nearly doubling of earnings in the current financial year, followed by around 31% earnings growth in the next financial year, and again a strong ROE of 27% this year should be maintained for FY18 also. So there is a scope for re-rating in our opinion for Glenmark, and a medium-term price of 1,186 rupees is what we are looking at with a 1.5 to 2 year perspective. In case of Jubilant Life Sciences, I think around say 500 rupees over the next 2 years is likely to, is sort of possible if the company delivers as per our expectations.
Just to also get a check from you on some of the banking and financial names. We're continuing to track what's happening in global markets and the currency. In the current context, I just want to take a check on some of the pockets there. We have seen a strong move on some of the PSUs. The private banks at this point are steady. NBFCs continue to be in focus. What's on your radar?
I think in light of the expected spike in risk aversion globally, and the fact that the banking franchises in Europe and UK are getting pummeled, I think this is not the time, in my opinion, to be adventurous in even the Indian context. And one needs to gravitate one's portfolio towards those franchises where the earnings growth, I think, is not is more or less secure, and at least for the next year or two. And from that perspective, I think although the retail-focused private banks have outperformed and do appear to be more expensive as compared to corporate-focused private banks and PSU banks, I would still sort of weigh in favor of those banks. So the franchises like HDFC Bank, IndusInd Bank, I think would, in my opinion, post at least 20 to 30% growth in earnings for this year and next year. And with a steady or improving ROEs, I think that's where I think I would advise investors to park large amounts of allocation. If at all, I think for private sector, corporate focused bank one is looking at, but I think Yes Bank stands head and shoulders above the other two large competitors. It has demonstrated a stellar asset quality after RBI's AQR review, both in December and March quarter. And going forward, the company has given a very strong guidance in terms of the just minor credit costs, I think 50 to 70 basis points they have said for FY17. They've handled asset quality especially well. So I think there is still some sort of upside left there if one is willing to take a 12 to 15 month perspective.
All right, Ajay, thanks so much for joining us. We've got some